NVIDIA is now cheaper than the S&P 500 for the first time since 2013. NVIDIA is currently trading at a forward PE of 19 times, which is below the S&P 500 benchmark of 20 times. So, why is it trading below the index? The answer is in South Korea, which is at the heart of the world's AI supply chain.
If you had invested $100 into the S&P 500 at the beginning of this year, this is roughly how much you would have in return. Put that same $100 into Kospi, South Korea's main stock index. Your return will be more than double. Kospi is now the best performing stock index in the world. It keeps going and going, topping 9,000 points, all because of two companies that are powering the global AI frenzy. You've probably heard of one of them, but it's not Samsung's phones or gadgets that are driving the stock market surge. It's these memory chips used for feeding and storing a massive amount of data in AI hardware, essential for training large language models like Claude and ChatGPT. Along with semiconductor giant SK Hynix, the two firms supply more than 2/3 of the world's memory chips. But AI titans like NVIDIA and AMD are still hungry for more. NVIDIA CEO Jensen Huang's high-profile South Korea trip earlier this month underscores the country's strategic importance in global AI infrastructure. A worldwide chip shortage has helped push South Korea past the UK and Canada to become the 7th largest stock market over the past few months.
Is the AI bubble busting, or is it a mistranslation on a Korean headline? Today, I'm going to be your guide from the east to the west as a Korean trader. So let's go inside the data and let's see what's really going on. South Korea's stock market is up approximately 200% in 12 months, while the S&P 500 is only up 26%. This is entirely driven by SK Hynix and Samsung's explosion into the $1 trillion club. And if they were SPS components, SK Hynix and Samsung, along with Micron, would be in the top 12 in the world. Modern AI GPUs from NVIDIA rely on high bandwidth memory, or HBM, which is stacked directly next to the processor and can transfer data much faster than the conventional DRAM. Traditional memory, DRAM, is like a single lane highway connecting the memory to the processor, the GPU. So, to put it in an analogy, if traditional DRAM is a suburban sprawl, HBM is a skyscraper with an ultra-fast elevator system. And it brings memory physically closer to the GPU and multiplies the data bandwidth exponentially. Producers can't instantly add capacity. This supply constraint gives companies like SK Hynix pricing power. So on June 24th, a black swan called Black Tuesday has spread its wings. Investors suddenly took profits after an enormous AI-driven rally. And South Korea's market fell sharply, with memory stocks like SK Hynix and Samsung among the biggest decliners. Aside from the March 4th panic, this was the sharpest single drop since the 2008 financial crisis. Investors got nervous over reports that NVIDIA could reduce production of future AI chips. SK Hynix might slow some HBM4 capacity expansion. The market interpreted that as, what if HBM demand starts slowing? Now, let's talk about what actually lit the match, because the HBM story gave algorithms an excuse to sell. But this is what turned a pullback into a circuit breaker.
Bro, Korean stock market is at all-time high, but everybody in Korea looks like they just got dumped by their girlfriend. Your friend made 200%, your coworker made 150%, you made 20%. Bro,
Ajushi or Unk has got a point there.
Korea is experiencing FOMO now. It means fear of missing out, the feeling that everyone is making money except you. The Korean stock market has been the world's best performing markets this year. Suddenly, everyone is talking about stocks, on the subway, at work, even during lunch, and honestly, I'm one of them. When SK Hynix was 800,000 won, I thought, too expensive. At 1.2 million won, still too expensive. At 2 million won, this is crazy. Then I bought it at 2.5 million won. That's FOMO. You don't buy when it's cheap. You buy when everyone else is already celebrating. Will I make money?
The domestic Korean retail market, the ants, are the middle and working class. Over 30 million people with skin in this market. When the ants lose money, politicians lose jobs. In late May, just weeks before this crash, Korea's Financial Supervisory Service, the FSS, approved 2x single stock leverage ETFs on the Samsung Electronics and SK Hynix, brand new tradable products. And they've only had been live for about a month when Black Tuesday hit. So why did they approve them? Retail money was hemorrhaging out of Korea. The ants were dumping the Korean won to buy US tech and Hong Kong listed leveraged chip funds. Capital was draining out of the domestic market. The FSSS approved these domestic leveraged products specifically to keep the retail money onshore and stop the currency drain. The ants piled in, and then Monday happened. Wall Street had a soft close, and Samsung and Hynix ticked lower on Tuesday's open following the Chosun Biz article. And FSS Governor Lee Chung-jing walked into a press conference. What he said next triggered the entire cascade. He openly admitted on camera that he deeply regretted approving these leverage ETFs. He stated the products had merely volatility loaded the domestic market to fatten the pockets of brokers. And then he said this: I should have laid down on the floor to block this. Now I need to stop here because this sentence is everything, and you can't understand it without understanding Korean political culture. To Western ears, that sounds like a progressive reformer, admitting a mistake and taking responsibility. That's not what this is. In South Korea, financial regulators are culturally expected to act as fatherly guardians of public wealth. The phrase, lie down on the floor, in Korean, this invokes a deeply specific image. Using theatrical, dramatic language to preemptively shift blame before millions of retail ants come for his job. He held this press conference before the worst of the crash had even finished unraveling. And that timing is not an accident. In Korean political culture, a deeply theatrical public admission of guilt, delivered before the mob assembles, can sometimes blunt the rage before it turns into resignation demands. He even specifically said, I'm translating here. Since most investors are middle class and working class of individuals, exposure to a sudden volatility could deliver a significant shock. Every institutional risk desk in Seoul starts pulling liquidity immediately. Market makers de-risk. Samsung and SK Hynix tick lower. That triggers automated margin calls inside the leverage ETF structures. Forced liquidations cascade through the system. Circuit breaker fires at 10% gone in one session. And this is Black Tuesday. So is this signaling the pop of the AI bubble? Let's go through quantitative studies using the South Korea as a leading indicator of whether or not the bubble pops or grows from here. The South Korean economy grew to the largest quarterly expansion since Q3 2020. This was led by exports. Semiconductors up a record 170%. Computer-related products and oil products also saw sharp rises of more than 290% and 46%, respectively. Wall Street panic sold SK Hynix on a translated headline about HBM slowing down. JPM's own model shows DRAM margins near 80 HBM revenue going vertical to 17 billion per quarter and a capacity expansion schedule running through 2028. Standard retail market theory dictates that when a market goes vertical as the KOSPI has, valuations are supposed to get bloated, expensive, and speculative excess. This chart shows the exact opposite occurring. The white line is pressing aggressive, historic highs, and the actual valuation multiple, the orange line, has completely inverted, collapsing down to a rock bottom approximately 7 times forward PE. This is the definition of a structural re-rating. The index isn't climbing because of speculative multiple expansion. Now look at this JP Morgan chart on global equity valuations. South Korea is trading at just 8 times forward earnings, the cheapest market in the entire world. The US is at 22 times, Taiwan at 22, and even China is at 11 times. Korea is nearly at a 60% discount to the US on a PE basis, and it just had the best performing stock market this year. The key question is whether Korea is near peak earnings. Goldman raises its price target for South Korea's Kospi index to 12,000, which is currently at 88,000. They see another 35% upside move by year end. They say we remain overweight Korea and raise our Kospi target to 12,000, implying 37% return. This is driven by a higher earnings and conservative 8 times forward PE multiple. We acknowledge that the market has more than doubled this year, that Samsung Electronics and Hynix now account for over half the market cap, that retail speculative activity has increased, and that the market is vulnerable to a correction. We suggest a downside protection strategies later, but argue the strategy's case for Korea remains compelling. Look, the risk is real. The market has more than doubled this year and is concentrated in 2 names. Retail speculative activity has picked up. A pullback is possible, and Goldman says so themselves. This is what my option spread trade structure can hedge. The strategic case remains compelling. Cheapest market in the world, record earnings growth. Goldman target implying 37% more upside and still trading at a fraction of what every other major market trades at. It's hard to find a better risk-reward setup globally right now. Now, US traders can access Korean markets with the ticker EWY. And my EWY trade has been the best trade so far this year for me. Using a systematic quantitative approach, I was able to identify the Korean trade back in February. The structure was a EWY options diagonal spread and close to a 332% trade before the sell-off. If you want to access low effort, asymmetric return option trades like this is exactly what we break down inside the next video. It is about why the best trade I've ever made didn't come from a model. It came from knowing what the model was missing.